What are some tangible steps a business can take to boost its chances of qualifying for subordinated debt? I'm sure there are things you can do to make your business more appealing to lenders.
The most important step is to get your financial house in order.
Okay.
Focus on generating consistent revenue, improving your profit margins, and maintaining a healthy cash flow. That's the foundation of a strong application.
So it's like getting financially fit before you go for a run. You need to build up your financial stamina to handle the demands of subordinated debt.
That's a great analogy. You also want to work on building a strong credit history. Pay your bills on time, keep your credit utilization low, and monitor your credit report regularly. If you have any outstanding debts, try to pay them down or consolidate them to improve your debt-to-equity ratio.
It's all about demonstrating to lenders that you are a responsible borrower who can handle the financial responsibility of a subordinated debt. And of course, we can't forget about the importance of a compelling business plan.
Absolutely. Lenders want to see that you have a clear vision for your business, a solid growth strategy, and realistic financial projections. Your business plan is your opportunity to showcase your passion, your expertise, and your commitment to success.
It's not just about crunching numbers. It's about telling a captivating story about your business and its potential. You need to capture their attention. Convince them that you're a good investment and that this subordinated debt is going to help your business reach new heights.
You've hit the nail on the head. It's about building a strong case for your business and demonstrating that this loan is going to be a mutually beneficial partnership.
Okay, so let's say I've done everything right. My financials are impeccable, my credit score is stellar, and my business plan is so well written it could be published. But I'm still feeling a bit hesitant about taking on subordinated debt. What are some of the key risks and considerations I need to weigh before making this decision?
You're right to be cautious. Subordinated debt is a significant financial commitment, and it's not a decision to be taken lightly. One of the most important things to consider is the impact on your cash flow.
Okay.
Those higher interest payments will affect your monthly expenses, so you need to make sure you can comfortably handle those payments without putting a strain on your operations.
So it's about running the numbers and making sure those higher payments won't derail your growth plans or force you to make tough decisions about cutting costs in other areas. What about the impact on my future borrowing capacity? If I take on subordinated debt now, will it make it harder to secure additional funding down the road?
That's a valid concern. Taking on subordinated debt will increase your debt-to-equity ratio, and it could potentially lower your credit score, which might make it more challenging to qualify for traditional loans or other forms of financing in the future.
So it's like playing a game of financial chess. You need to think several moves ahead and consider the long-term implications of your decisions. What about control? Are there any risks associated with losing control of my business when taking on subordinated debt?
That's an important consideration, especially if you're dealing with convertible subordinated debt. Remember, convertible debt gives the lender the option to convert their debt into equity in your company, usually at a predetermined price or under certain conditions.
Right, it's like giving the lender a potential pathway to ownership.
Exactly. While this can make the debt more attractive to lenders and potentially lead to better terms, it also means you could end up giving away a portion of your company if the lender decides to convert.
So it's a trade-off. You might get access to capital on more favorable terms, but you could also relinquish some control and ownership.
Precisely. It's about weighing the potential benefits against the potential risks and deciding what's best for your long-term vision for the business.
Okay, so we've got higher interest rates, potential impact on future borrowing, and the possibility of losing some control. Any other risks kind of lurking in the shadows that we should be aware of?
Well, the most significant risk is the possibility of default. If your business is unable to make those loan repayments, you could face serious consequences.
Let's talk about that. What exactly happens if you default on subordinated debt? What are the repercussions?
The consequences can be pretty severe. The lender could seize your assets, you could face legal action, and your credit score could take a major hit, making it extremely difficult to secure any type of financing in the future.
It sounds like default is the ultimate financial nightmare, something you want to avoid at all costs.
It's definitely a situation you want to prevent. That's why it's crucial to manage your debt responsibly, communicate openly with your lender if you're facing challenges, and explore all possible options before you reach the point of default.
So communication is key. Don't bury your head in the sand if things get tough. Reach out to your lender and work together to find solutions.
Exactly. Lenders are often more willing to work with borrowers who are proactive and transparent about their financial situation.
Okay, so let's say I've carefully considered all the risks and decided that subordinated debt is simply not the right fit for my business. What are my alternatives? Are there other ways to access capital without putting my company at risk?
Absolutely. There are a variety of other financing options out there, and the right choice for you depends on your specific circumstances and goals. Let's explore some of those alternatives.
Perfect. That's exactly what I was hoping we'd cover.
Yeah.
What about traditional bank loans? Are those still a viable option in today's world of fintech and crowdfunding?
Definitely. Traditional bank loans are still a popular and often very cost-effective way to finance a business. They typically offer lower interest rates than subordinated debt, but they also tend to have stricter eligibility requirements.
So it's like trying to get into a prestigious university. You need a stellar academic record and glowing recommendations to even be considered.
Hmm.
What are some of those requirements that banks typically look for?
Banks are generally more risk-averse than other lenders, so they're going to want to see a strong credit history, a solid business plan, and usually some form of collateral to secure the loan.
Okay.
They'll also carefully scrutinize your financial statements and cash flow projections to assess your ability to repay the loan.
So it's not just about having a great idea or a passionate team. You need to have the financial track record and the assets to back it up.
That's right. But if you can meet those requirements, a bank loan can be a very advantageous way to finance your growth.
Okay, what about equity financing? That seems to be the go-to option for a lot of startups these days. What's the appeal of that approach?
Yeah, equity financing has become incredibly popular, and for good reason. It allows you to raise capital without taking on debt, which can be a huge advantage for early-stage companies that might not yet have the revenue or the assets to qualify for traditional loans.
So it's a way to fuel your growth without adding to your debt burden. But I'm guessing there's a trade-off involved. What's the downside of equity financing?
The main trade-off is that you're giving up a portion of ownership in your company.
Right.
When you take on equity investors, you're essentially bringing on partners who have a stake in your business's success. They'll have a say in how the business is run, and they'll share in the profits.
So it's about finding the right balance between maintaining control of your business and leveraging outside capital to fuel your growth.
Exactly. And the type of equity financing that's right for you depends on your business stage, your growth goals, and how much control you're willing to relinquish.
Okay, so we've got bank loans and equity financing. What other alternatives are out there for businesses that aren't a good fit for subordinated debt?
Well, crowdfunding has become a powerful force in the world of business financing.
Yeah.
It allows you to tap into a large pool of potential investors, often individuals who are passionate about supporting small businesses or innovative ideas.
So it's like taking your funding pitch to the masses. Instead of going to a bank or a venture capitalist, you're going directly to the people. I love that concept. But how does crowdfunding actually work? What are the different models involved?
There are a few different types of crowdfunding. Reward-based crowdfunding is popular for businesses launching new products or creative projects. You offer backers rewards such as pre-orders of your product, exclusive merchandise, or even experiences related to your business in exchange for their financial contributions.
It's like pre-selling your product or service to a crowd of enthusiastic supporters. What a great way to generate buzz and build a loyal customer base before you even launch. What are some of the other crowdfunding models?
Another popular model is equity crowdfunding, where you're selling shares in your company to a large number of investors. It's similar to going public, but on a smaller, more accessible scale.
So it's a way to democratize investing, giving everyday people the opportunity to invest in companies they believe in. Are there any other crowdfunding options we should be aware of?
There's also debt crowdfunding, sometimes referred to as peer-to-peer lending. It's essentially getting a loan from a group of people instead of a bank or traditional financial institution.
So it's like bypassing the traditional financial gatekeepers and tapping into the collective wisdom, or at least the wallets of the crowd. It seems like crowdfunding has opened up a whole new world of possibilities for businesses seeking funding.
It definitely has. And each of these crowdfunding models has its own pros and cons. So it's important to do your research and choose the one that best aligns with your business goals and your comfort level.
That's a great point. It's not a one-size-fits-all solution. You need to find the model that's the right fit for your business and your vision. Okay, so we've got bank loans, equity financing, and crowdfunding. Any other alternatives to subordinated debt that we're missing? What about government programs or grants?
Ah, yes. Government grants and loans can be a fantastic option for businesses that meet certain criteria. There are a variety of programs designed to support specific industries, small businesses, or businesses located in economically disadvantaged areas. It's definitely worth exploring the resources available through your local, state, and federal government agencies.
That's a good reminder. Sometimes those government programs can feel a bit bureaucratic, but they can also be a real lifeline for businesses that qualify. What
Good
about
point.
vendor financing? Is that something we should consider?
Vendor financing is another option that's often overlooked. It's essentially getting financing directly from the companies you do business with.
Right.
For example, if you need to purchase new equipment, your supplier might offer financing options that allow you to spread out the payments over time.
So instead of going to a bank or a lender, you're working directly with your suppliers to secure financing. That seems like a very practical and potentially mutually beneficial approach.
It can be. It often streamlines the process and strengthens your relationship with your suppliers.
Are there any other alternative financing options that we should mention?
One more I would add is microloans. These are small, short-term loans that are often offered by nonprofit organizations or community development financial institutions. They're a great option for startups or very small businesses that might not qualify for traditional loans.
So they're like starter loans designed to help businesses get off the ground and build a track record of success.
Exactly. And the good news is that you're not limited to just one financing option. You can combine different types of financing to create a strategy that works best for your unique situation.
That's empowering. It's like having a whole toolbox of financial instruments at your disposal, allowing you to create a custom-tailored solution for your business.
Precisely. The key is to be creative, resourceful, and persistent in your pursuit of funding.
Okay, so let's say I've weighed all my options, considered the risks, and decided that subordinated debt is the right path for my business. But now I'm faced with this sea of potential lenders. How do I choose the right one? They all seem to be offering similar terms and rates.
While interest rates and repayment terms are certainly important factors to consider, they're not the only things that matter.
Right.
You also want to look at the lender's experience, their reputation, their understanding of your industry, and their overall approach to working with small businesses.
So it's like choosing a business partner, not just a financial transaction. You want to find someone who shares your values, understands your vision, and is committed to your success.
Exactly. You want to find a lender who's invested in your journey, who's willing to be a supportive partner, and who you can trust to be there for you both in good times and in challenging times.
Okay, so how do I find that financial soulmate? What are some practical steps I can take to identify the right lender for my business?
First and foremost, do your research.
Okay.
Look for lenders who specialize in working with businesses like yours. Read reviews, talk to other business owners, and get a sense of the lender's reputation in the market.
So it's like checking their online dating profile before you swipe right. You want to make sure their values align with yours and they have a track record of successful relationships.
That's a great analogy.
Yeah.
And once you've narrowed down your options, don't be afraid to ask a lot of questions.
What kind of questions should I be asking? What are some key things to kind of probe to make sure it's a good fit?
You want to understand their lending criteria, their approval process, their reporting requirements, their fees, and their overall approach to working with borrowers.
So it's a financial interrogation of sorts.
Mm-hmm.
I need to make sure they're the real deal and not just trying to sell me something that's not right for my business.
Well, maybe not an interrogation, but a thoughtful conversation is definitely in order.
Hmm.
You want to get a sense of their philosophy, their values, and how they approach risk.
Okay, so I'm peppering them with questions, trying to figure out if we're a good match. Are there any red flags I should be on the lookout for?
Mhm.
What are some warning signs that might indicate this is not the right lender for me?
Absolutely. If a lender seems evasive, if they're pressuring you to make a quick decision, if their fees seem excessive, or if they're not willing to be transparent about their terms and conditions, that's a big red flag.
Oh, trust your gut. If something feels off, it probably is.
Exactly. Don't be afraid to walk away if a lender doesn't feel like the right fit. There are plenty of other options out there, and it's worth taking the time to find a lender who you feel comfortable with and who you believe will be a true partner in your business's success.
That's incredibly reassuring. It's a reminder that I have the power to choose and that I shouldn't settle for anything less than a perfect match.
You've got it. Finding the right lender is a crucial step in the subordinated debt journey.
This has been so helpful. I'm feeling much more confident about navigating the world of subordinated debt. We're going to take a quick break to process all this great information, but when we come back, we'll explore the final frontier, managing subordinated debt responsibly and maximizing its potential for your business's growth.